Hi, everybody. This is Josh Jalinski, the financial quarterback, and we're being joined by a good friend and buddy of the broadcast, Steve Blumenthal, talking about his latest On My Radar, which I thought was your best On My Radar I've read in a while. We'll talk about what On My Radar is. We'll get his view on the market and just how overvalued it is. But before we begin, Steve, describe your background for listeners who are new to you and your work.
Oh, well, thank you, Josh. Thanks for having me on. It's great to see you again. I am an investment advisor. I began my career in 1984 with Merrill Lynch Institutional. I was on an options arbitrage desk, stayed at Merrill when they closed the institutional office in Philly, moved it to New York. I stayed in Philly and built up an advisory business. We are a multifamily office structure. We also service other independent advisors. Where we do a lot of their back office engine trading, billing, that sort of thing.
Wonderful. And you also now work with good buddy John Malden, too. And
John's a part.
So how's that going?
Well, it's great. He's a joy to work with, a lot of fun, upbeat, smart man, a fantastic writer on all things macroeconomics, markets, those sorts of things. So it's going great. Yeah, I really enjoy. He joined. We merged he closed his investment advisory shop down a couple of years ago. Convinced him to merge it in with our shop, and he's a great partner.
Yeah, that's fantastic. So let's go to your latest On My Radar. I was really impressed by the charts, graphs, all that stuff. Talking about the Fed valuations and genius. So let's talk about that. And folks, we'll also tell you how you can get On My Radar as well. But first, I love how you open with the quote. You quote Jerome Powell. And what did Jerome Powell say? That was your first quote of the On My Radar. Do you remember? I would say
that the market's not that overvalued.
Somewhat elevated. I have a feeling that quote, this was the quote, I would say that asset valuations are somewhat elevated. And I thought, is that our, irrational exuberance quote? Like, is that sort of the canary in the coal mine? What say you?
So it sure could stick. It sure could stick. We are at overvalued levels higher than we've ever been. So it's by most every metric. And what's fueling things are Fed creating a massive amount of liquidity that has found its way into equities. With zero interest rates, ag bond funds at 2%, 10-year treasuries at 1.5%. It just won't work. And so in the what else am I going to do category, investors have raised money into equities and bid up prices to the highest level in history. So I think that quote will come back and bite them.
Yeah, I do too. It seems like one of those ominous quotes too, like this will be around forever. So let's talk about interest rates. Where do you think interest rates are headed? What data have you been researching on the whole interest rate debacle? I know you originally were like a bond guy, right? Weren't you a bond desk guy?
Oh, we still do it. Yep. We still do a lot of bonds. We trade the trends in the high yield junk bond space. So that's still one of the strategies that we have on the shelf in our investment kitchen. I would say it's not the right time for it. We need some sort of liquidity shock within the system. The number of companies that are living on borrowed money well beyond where we've been before is epic. The credit quality is the poorest it's been in history. And so when we have the next liquidity crisis, there's going to be a lot of companies going out of business. Well, let's say defaulting on their debt and running risk of going out of business. But we still do that. Where are interest rates going? I'll give you a couple of thoughts on that. Overall, my fundamental view, and I'll begin adding I could be wrong, my fundamental view is we are at the very late stages or the very early stages of a major move in interest rates higher. Back when Paul Volcker came in to fight inflation and drove interest rates up to 15%, it fought and won and beat inflation. We are completely at the opposite end, where the Fed has been giving and giving and giving the liquidity into the system like never before. And we have not only interest rates that are very, very low. The Fed's still stuck at zero interest rate policy, 10-year at 1.5%. You factor inflation in, we're negative real rates in a big way. Just haven't been here before. And it's not just here, it's pretty much everywhere. So my view is, in the end, there will be inflation. And I've been saying that and writing about that for a couple of years, and we are finally seeing it in the last 6 months. Transitory is no longer a common word used by Powell. So inflation's here, it's painful, and it's not yet under control. So I'll give you two things. My fundamental view is ultimately interest rates are moving higher. In the near term, the fact that the bond market has responded in the face of the Fed eliminating the Fed purchases of $120 billion a month by March 15th and beginning to raise interest rates, to their word, 3 times in 2022. I don't think they're going to be able to do that. So I think near term, we're going to have one more shot lower in interest rates. I'm looking to refinance the mortgage and have been for a second or third time on this way down. But ultimately, maybe the 10-year can get down to 1%, but ultimately we're going to be looking at much higher rates, and I would say 2023 to 2024 in that period. Because what I think will happen is, I think we're going into this inflation shock certainly slow things down. Before the Omicron variant, we've been slowing globally. China's been a major engine. China's clearly in reverse, cracking down. The real estate market there is in crisis, and they've been an engine to global growth. So I actually think we're going to go to a global slowdown over the course of the next 6 months. One more shot down in interest rates is my view. And then I think rates are moving higher because next summer, I suspect that if we do have a big down in the market and we do have a big slowdown globally in equities, when we're priced to peak perfection and overvaluation, that's going to be a tough situation. So to see the market go down 30% by next summer, I think is a possibility. And if I'm right and that happens, the Fed is going to come in with big guns a-blazing, probably bigger than before, and that liquidity will be one more push higher for the equity market. So I don't believe the bull market is over. I think 2023, 2024 would be a good guess. So with all that said, my favorite indicator for bonds is what I call the Zweig bond model, named after the great Marty Zweig. And years ago, in his friendship and work with Ned Davis Research, Ned Davis, they created a bond indicator called the Zweig bond model. And a lot of years ago, I had Ned and his team repurpose and recreate it, bring that forward. And so I follow it. It's been right and helped me over the years many, many times. And it's been bullish, meaning interest rates are heading lower. It's still in a buy signal for lower interest rates, but higher bond prices. And I like that it's matching my current short-term view, but both could be wrong.
Now, your friend, you write about this in your latest On My Radar, your friend David Rosenberg says they're not going to raise rates next year. Would you agree with that?
I think it's a good chance. I think it's a good chance he's right. You have every time the Fed has attempted to exit this stimulation that they brought, the markets responded very poorly. The last time this happened was in December of 2018, going into that period of time. The Fed had been tapering, raising interest rates, and then the famous taper tantrum, and Fed pivoted Powell pivoted right before Christmas, and then the market rallied. The market was down 20%. We're in a deeper trap than we were then. Inflation was not an issue to the degree that it is here. You could argue that the employment numbers are in a good place and the inflation numbers are well above 2%. The Fed is kind of stuck. So I believe that any attempt to taper just because of the debt load, we owe so much. You raise interest rates, that slows an economy in a big way. And I just think the Fed is stuck.
Well, folks, when we return, we'll be asking Steve Blumenthal of CMGwealth.com about his take on, he wrote about this on Chamath's idea of venture capital. That was a pretty exciting read. Also, what are some of his favorite indicator, the famous Warren Buffett indicator? What does that tell about the market? And more. This is Josh Jalinski, the financial quarterback. And call us 888-988-JOSH, 888-988-5674 for your free Income for Life blueprint, 888-988-JOSH. And check out, Steve, where can people learn more about your work?
Well, on our website, it's cmgwealth.com. And at the bottom of the homepage, there's a sign up for On My Radar. So the letter's free. We send it to about 50,000 readers. And we talk about, and I often show my favorite indicators in there.
And it's a fantastic read every week. So, folks, give us a call, 888-988-JOSH, 888-988-5674 for your year-end review or New Year, New You review. Give us a call, 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Jalinski, the financial quarterback, with Steve Blumenthal of On My Radar, all-around great guy in the world of money management, talking about valuations and some of his favorite indicators. So every week you go into your indicators and On My Radar. You did a lot of charts on this On My Radar, this past one. What is your favorite indicator that you're watching right now to figure out where the stock market's headed? We talked about the bond market. I guess the Zweig bond model is your favorite one of the bond market. Where are you seeing, like, what is your favorite indicator of where stocks are headed?
Well, there's two. One is, I call it the Ned Davis Research CMG long flat indicator. And essentially, it is, in my view, a more timely indicator than Ned's famous Big Mo. So what is Big Mo? Big Mo stands for momentum, arguably a much better name than the CMG long flat indicator. But both, what they do is they look at what's something called market breadth. So we're looking at how many stocks are going up versus how many stocks are going down, kind of the rate of the move, the pace of the move. So there's a number of indicators. In case of ours, we look at 24 sub-industry sectors. And think of it this way. When markets are healthy, most equities are participating in that rally. You've got broad, almost like an army on the field going into battle. You have 100 soldiers or 500 soldiers, and they're going into battle. And if you lose half the soldiers, your chance of winning that battle becomes more difficult. Same with equities. Equity is actually a great leading economic indicator. And stock by stock, when you start to see breakdowns across multiple sectors, then you start to get concerned that we're either leading towards a slowdown in the economy, recession, those sorts of things. So no indicator is perfect. Some have a higher probability and a higher win rate than others. And what we're looking for is the weight of evidence of the market and what's it telling us about the direction of equity. So, for example, despite how overvalued the equity markets have been, both our indicator and Ned Davis Research's Big Mo indicator have been in bullish buy signals. Now, both have been deteriorating lately, but they're still in bullish buy signals. So despite my view that the equity market is going to be in trouble going into next year, and maybe a minus 30 type of risk to it. I'm not seeing that in our indicators yet. They're deteriorating, but it's not in a sell yet.
And you also wrote a recent book, Navigating Stock Market Cycles. And I don't know if we've ever had you on to talk about that book, so I also want to get your take on your latest book. That's exciting. And I'm trying to look at on my radar. Where is the Big Mo chart? Is that on here?
No, I don't publish it because it's proprietary to Ned Davis. But I do publish and show each week the CMG Ned Davis Research long flat indicator.
And that's saying things are overvalued, but maybe not yet heading south.
Well, there's two different things that you're bringing up. One is, how expensive is a market? Markets can go on being expensive for a very long time and can continue to inflate. Right now, the narrative is the Fed has our back, and that liquidity has fueled a market to move to the most overvalued levels in history. That's just the state of where our starting conditions are today. Then think in terms of risk on, risk off. That's what I like about what we do with our equity indicator. It's when do we hedge or when do we not hedge? When do we lighten up or when do we not lighten up? And it's a rules-based process that isn't right every time, but it's been right the majority of times. And it gives us a good sense of what, in the way that money works, it's about, when you have wealth, you don't want to lose your money because of how compound interest works against you. It's very difficult to come if you have $100,000 and you lose 50%, you're at 50,000. You need 100% gain to get back to even. That's not so easy to do. So you want to correct against the really big mistakes because that's what depletes wealth. So there's ways to hedge and do some things around it. And there's also thoughtful ways about how you allocate. And I like where you're going with this venture discussion. But anyway, so valuation is one thing and one way to look at the market. In my book, On My Radar, Navigating Stock Market Cycles, I've shared what I believe are the important markers to watch to keep on your radar as to how to manage risk and how to think about wealth and how to grow money.
No, fantastic. And folks, we will give that book to you for free. I'll buy it. You can buy it on Amazon or wherever books are sold. Just search for On My Radar, Navigating Stock Market Cycles by Stephen Blumenthal. Or you can go on Amazon, or you can go probably on, can you buy it on CMG Wealth? Or
I really like the idea of you buying everybody a book, so that sounded good to me.
If anybody calls and schedules a no-obligation review, I will buy that book, 888-988-JOSH. Give us a call or go in, give us a book. Great resource to our listeners. And next, let's talk about the Buffett. Oh, you know what? Before we go to the Buffett indicator, we'll go to that next segment. Divergences right now. The Dow, the NAS, the New York Composite, the transports, a bunch of them. The highs are in the rearview mirror. The only one that we're seeing that might break out to a new high is the S&P. Do you look at that as an indicator? Because there's some divergences, and that's usually indicative of a market top when one of the five big indexes is making a new high, but the other aren't. Do you look at that as an indicator?
Oh, totally, and everything you're saying is correct. When you start to see those big divergences, what you're really looking at is fewer and fewer stocks are driving the markets higher. So in last week's On My Radar, one of the charts that I had, courtesy of a friend of mine, Jim Bianco, he tweeted out a chart that shows the top five stocks and what percentage those top five stocks are so you got the 500 stocks in the S&P 500 index. 5 stocks represent over 25% of the index, just 5 stocks. And they're driving the bulk of the returns. And they're the FANG stocks.
Yeah, and I remember
everybody is so heavily concentrated into just a few names. And then you start to worry.
And I think one time I approached you and I said, could you get your guy to do FANG Mant or FANG Man? you remember this?
Yes.
We
yes,
did
yes.
Facebook, Amazon, Apple, Netflix, Google, Microsoft, Apple, NVIDIA, Fangman. And I believe that was like that's been something like 50% of the gains since like 2016. It's been crazy.
Yeah.
And if you throw Fangment, you throw Tesla in there, that may be like 60 or 70% of the gains. I'm not a, I really haven't evaluated that since we talked about it years ago. That's got to be, those like 9 to 10 stocks have to be maybe 50% of the gains at least. Because think about it, all of the, you know what's sad? So many good companies of old have really not done very well over the last 5, 6 years. You know, if you think about IBM, GE, Ford until this, past year, uh, good companies have really been sluggish. AT&T, Verizon. I mean, heavy debt loads. Are you doing any research into that? Like, so the old stodgy, like dividend payers, aren't really doing it anymore. That's not a good thing for the economy. What do you think about that?
Yeah. Well, I agree with you. We're big believers in high and growing dividend stocks. These are companies that have cultures of rewarding, with histories of rewarding shareholders by increasing dividends. So they pay a high dividend and they increase those dividends every year. But the yield on that portfolio is about 4%. We'd like it a lot better if it was north of 5%, but that's where we are. And value in general, because these are value-oriented companies, has significantly underperformed growth. And growth in general has significantly underperformed just a handful of stocks. So we've got fewer and fewer stocks that are driving the markets higher. At the same time, we've got margin levels at record highs. Margin levels relative to what our country can produce in GDP is at by far the highest level. And the scary part on that is that so many people are concentrated in such few names that are pulling the weight to most things that's why I don't think when we have a correction, it's not going to be 5 or 10%. I think you're going to see a pretty good unwind of risk and defined by massive amounts of leverage in terms of margin debt. So
fantastic. Well, that's maybe not
the tricky part.
Maybe not fantastic, but a good point. So, folks, give us a call, 888-988-JOSH, for the On My Radar Navigating Stock Market Cycles book. Go over to cmgwealth.com, subscribe to an excellent newsletter, On My Radar, by Stephen Blumenthal, who's joining us today, and give us a call during the break, 888-988-JOSH. That's 888-988-JOSH, 888-988-5674. We'll be back after this. And we're back. This is Josh Jalinski, the financial quarterback, being joined by Stephen Blumenthal. Are you best-selling author, Stephen Blumenthal, yet? You should be.
Well, I did hit it. Yeah, I did with Amazon. Yeah, I did hit it with Amazon.
Good job. Amazon bestseller, Stephen Blumenthal, On My Radar, Navigating Stock Market Cycles. You can get it on Amazon, wherever books are sold, or I'll buy it for you, 888-988-JOSH. So let's talk about the Buffett indicator. First, what is the Buffett indicator? Always like your hamburger story, and I think it's always good to tell. So go ahead.
Okay. All right. Well, it's really Warren's hamburger story and not mine, but I love it too. So the Buffett indicator looks at the total stock market capitalization. So that is every share, every publicly traded share of every stock times that stock's price. And you add that all together and you get the total stock market cap, the size of the market. And then when you look at that size of the market as a valuation and you compare it to what our country can produce as a whole, then you get a ratio. And that ratio is at the highest level in history. And the way that Warren Buffett described it, he said, stock market cap, total size of the market, relative to GDP is his favorite valuation indicator. and he explained it kind of like hamburgers. He said in the Buffett family, they love hamburgers. When hamburger meat goes down in price, they can buy a lot more for their money, and they sing the Hallelujah chorus in the family because they love hamburgers. But when it goes up in price, hamburger meat goes up in price, they weep because they can't get as much for their money. He doesn't understand why people don't look at the stock market the same way. You just don't get the great return. What I didn't show in that last on my radar, but I've shown in past ones, is that the level of valuation, it doesn't give us really any indication of what the market's going to do or when the cycle is going to peak and we move from bull market to bear market. But what it does do very well is gives us a good indication of what returns are going to be over the next 3, 5, 7, 9, 10 years. And for the first time in following this in a very long period of time, those returns are projected to be negative out every one of those periods, 3 years, 5 years, 7 years. So, along the way to flat returns, it doesn't mean that people can't do well. It just means when the hamburger meat's really super expensive, I think it's a good time to hedge or de-risk a little bit and then be in a position to take advantage of the unwind that margin creates and the volatility when margin unwinds it creates. And the reason market's the bottom is that it's that unwinding and forced selling by brokerage firms and forcing people out of positions, and would-be buyers back away, and you get this vacuum. So you want to be in a position to buy the hamburger meat when it's on sale. Your returns are going to be better, and they're not going to be as good when they're up high like they are right now.
You mentioned hedging. How are you hedging? What are you seeing as a good value right now when interest rates are near record lows and, looking like we're headed on an uptrend in interest rates, maybe not next year, maybe the year after. So bonds maybe aren't a good value. Stocks maybe aren't a good value. Like where is the opportunity?
Well, if you have the knowledge to be able to understand option contracts, puts and calls, you can buy a put that will, think of it like buying insurance on your house. You're buying insurance on your stock position. And you can buy a put, and it can protect you if the market dislocates. But there's an expense to doing that, and you have to do it in a disciplined way. So there's much to learn about how to do this. Fortunately, there are experts out there that do this. The way that the ETF market has evolved, I have a couple favorites that we utilize in our portfolio, and not a recommendation specifically for anybody because I don't know what your personal situation is. But there are ETFs that have hedge components built into it. One of them is a total stock market. We like the diversification in owning it. They own the total U.S. stock market. And there's an experienced options risk manager inside of the ETF who does the put buying for you. So I like something like that a lot, absent the ability to do it yourself.
Fantastic. Any other values you're seeing right now? Do you like gold? Do you like silver? Do you like whatever?
We're bullish on gold. We, believe it or not, are down to 2 crypto hedge funds that we like. We know we need to have some of that technology in our portfolios, a couple percent or at least. Bonds won't work anymore. That's a really important thing. So I'd maybe shift it and think about it this way, Josh, and perhaps this is a good lead into Chamath in that webcast that I shared in last week's On My Radar. I loved how he described thinking about wealth, and a lot of it resonates with us, and I learned a few things too. So what we're doing is we're focused on well-collateralized short-term private credit, 5 years and less, that has unique niche and edge that gives us, so we have enough liquidity, but we can produce returns, we believe, in, call it the mid to high single digits. And so we diversify to a number of those types of things. And we also include trading strategies so that we have a liquidity set. We call that core. We want to defend our core wealth. And core wealth for somebody might be 80% of their money. For somebody else might be 50% of their money. If it might be somebody like Chamath, who is worth the multiple billions, core wealth is just a small portion of his money. For him, it's in case everything goes to zero on his venture bets, then he's protected. So, but I do think that there are a number of opportunities, but particularly, and they're not available to all investors. So we like late stage private equity, things that we believe will have a path to liquidity in the relatively near future, called a couple of years, that has edge. And so if we can protect our core, then we're looking for asymmetric return opportunities that aren't 10 to 1 in 10 years. And there are opportunities like that with certain managers that seek, call it disruptive technology. So you hear a lot about that. But we're looking for things like in agriculture, bioengineering, a plant cell, to do it in a way that's learned from nature, so that the seed produces a plant that has a better trait, disease tolerant, a stronger pod for better yield for the farmer. So things like that. And we need, how about water reduction, less fertilizers needed, displaced chemicals, those sorts of things. So we're looking.
So that could be called the less poop fund.
It could. It could.
There you go.
So what Chamath is talking about is using his capital in a way to invest in things that make the world a better place. So the name of his fund that he runs is Social Capital. Most of it's his own money. And he's looking at things that improve healthcare, a cure for diabetes and obesity and Alzheimer's. And so a lot of those things are happening. The companies that are behind it need the capital to get them from here to there. And for us investors who are stewards of capital, how we allocate, I think it's really important. And so I like his way in thinking about risk, and how he protects his core and then looks for these types of opportunities. So there's a number of things like that we're really excited about.
Oh, fantastic. And when we return, we'll get some more of Steve's indicators, where he thinks the markets are headed, and more of his comments on Chamath. When we return, this is Josh Jalinski, the financial quarterback, and we'll get his take, talk about disruptive technologies. What happened with Cathie Wood this year? We'll get his take on that when we return. This is Josh Jalinski, the financial quarterback, and we'll talk about Bitcoin when we return. This is Josh Jalinski, the financial quarterback. And we're back with Stephen Blumenthal of On My Radar. Folks, if you want to subscribe to a fantastic free resource, go to cmgwealth.com, subscribe to On My Radar, or go to Amazon, buy his book On My Radar, or you know what, better yet, I'll give it to you for free when you schedule and keep your no obligation review at 888-988-5674. It is a Forbes special book, 888-988-JOSH. And Forbes just named me, by the way, the 23rd best financial security professional in the country. And make sure,
congratulations.
Yeah, my compliance department would want us to know there are certain disclosures and risks and all that stuff, and rankings disclosure. But yeah, that was fantastic. It's also fantastic that Forbes worked with you to publish your book. That's exciting. So, Steve, any more comments on this whole Chamath social capital? Some of it reminds me of the Seinfeld episode where they had the human fund, social capital, the human fund. So what else did you learn from the Chamath interview?
Well, so the good news for all of us is that I believe we're going to live longer. I believe we're going to live longer healthy. We're learning an awful lot. Think about 23andMe, for example. That's a whole different thing. But understanding and coding the DNA and how our systems work and how things work at a cellular level and how we heal certain ailments that were a big problem before. So I think all in general, there's some really good news around that. And then think in terms of the opportunity that exists for converting a tile roof to a solar panel that feeds a battery next to your house. So you're essentially, powering it. We're not there yet, but we're going to be there. And what does that mean financially to us all? And so that's something. There's a company that we're working with. It's a Philadelphia-based company. We're really excited. It's a biopharma company. There are risks, with investing in drugs and investing in drug companies, and we're behind helping them get to a point to get through their next several phase 2B trials, and then they get to a phase 3. But they're doing some interesting things with a hormone that's found in nature, and it's this gut-to-brain health. So there's stories here that, and many, that there's reason to be really optimistic about a lot of things. I'm not optimistic about an overvalued stock market, and then yes, Cathie Wood has gotten beat up, and I think that that's a little bit of a prelude to what can happen to everybody else that's so heavily concentrated in just the same few names. When you get selling pressure and certain things bid up, everybody was buying everything that Cathie was touching, and you get all that money racing into the same few ETFs. Those ETFs and those funds go to buy more of the same things, and you start getting some exodus from some of those funds. They're going to be sold. I believe that they have a wonderful culture of very smart people that are looking 5 years now out, not 5 months out, and they are identifying much like Chamath is trying to do and what we try and do at CMG.
Who, the Cathie Wood people? You think they're good people over there? Or do you think they're done?
No, I think they're very, very bright people. They have a process and they have a discipline in identifying companies. So no, I'm a fan. We have a Cathie Wood her top 11 picks on our platform. It's done better than the ETF has done. We are big believers in the highest conviction plays. But I'm a fan in what they're doing and how they think, and it takes some guts to think 5-10 years out.
And also, I mean, there was such epic growth in some of these companies, for them to lose, doing the human genome and gene editing and things like that. Those companies grew so high. I mean, they're naturally due for steep corrections.
Well, they became very expensive hamburgers.
Yeah, exactly. The hamburger analogy. So, talking about Cathie Wood, talking about Chamath, let's go back to your On My Radar from last week. You have various indicator price to sales. Oh, here's the thing you made me think about. Jeremy Grantham, the 3, the 5, the 10-year. He always talks about the 10-year thing. I remember him telling, though, some of these indicators, though, are wrong. Like, how do you navigate? So Grantham was a genius, right? Everybody said, oh, he was great. He was saying forward prospect for 10-year returns were very bad years ago, and then it ended up being that he was wrong. How do you wade through all these indicators? Like, who do you listen to? Who do you not listen to? I mean, Grantham was famous for being right on indicators. In the last few years, he's been wrong. Like, how do you weigh that as an investor?
Yeah. I go back to none of these are perfect, but what we can do is get a good sense of when risk is highest and return is least, and when risk is least and return is the most. The problem is, so none of them are perfect, and so you don't want to put all your bets on one process. You diversify trading managers like you would diversify stocks. You don't want to put it all on one thing. So it's a question about what the goals, needs, time horizon of your wealth is, and how do you protect the core, in our view, and then what do you do with what we call the explore side? What sort of investments are you looking at? there that give. But who cares what happens to the market? Is the field the challenge with what Chamath is doing and any private equity investor is doing is that it takes a lot of courage because the amount of information you know and the level of risk is so high when you're beginning that investment. But if you're going into an investment that is disrupting a major market, that the amount of money that they're seeking to capture is that potential market they're going after, diabetes, obesity, Alzheimer's, is so big, and you put 2% of your money into something like that, and it turns out to be a zero, then you're down 2% that year on that part of your risk budget. But if it does what you think it can do, it's a total game changer. So, we just have a different way of, we can look at the equity markets and yes, we have money in the markets ourselves. We have a lot of investors that have a lot of wealth in the market. We just think that there's a good way to play more defense at times and play more offense. You don't have to be perfect, and none of these are perfect. It's just look at things from a level of risk, and when risk is highest, it's when everybody's so darn sure and so comfortable and the market's skating and everybody's making so much money and the party's still going, and we believe that the Fed is all the great and powerful Oz until we learn that the Fed isn't at some point in time. Right now, that's not the narrative. The Fed is the narrative. So risk is high, play more defense, and there's ways to do that. When the harder part is when things are coming disconnected, when the margin calls are unwinding and market forced selling is happening, and that's when you want to be in a position. That's when the opportunity. And Sir John Templeton, who I just was a big fan for many, many years and still am, the great Sir John Templeton, who founded the Templeton Funds, Franklin Templeton Funds now, used to say that the secret to his success was he would buy when everybody else is selling, and he would sell when everybody else is buying. That's not perfect either, but it's a good discipline if you can stick to the rule, and that was the basis of how they built their business. I kind of think we're in a sell when everybody else is buying moment, and that doesn't mean I'm recommending to sell, but definitely play some defense and put some hedges in place.
Oh, that's a great tip for our listeners. And folks, when we return, we'll be back with the final segment with Stephen Blumenthal. And folks, if you haven't subscribed yet, go to cmgwealth.com, subscribe to his On My Radar. And folks, if you want his book, go to Amazon, search for On My Radar by Stephen Blumenthal, or you get it for free. I'll buy your book. Call us, 888-988-JOSH, request a free review. And if you meet with us, we'll give you a book free, 888-988-JOSH, 888-988-5674. We'll be back after these messages. And we're back with Stephen Blumenthal, author, Amazon bestseller of On My Radar, and cmgwealth.com On My Radar newsletter writer, 50,000 plus subscription list. So, Steve, what haven't we talked about that you've been researching that you want to share?
Oh, well, that's a good question. I'm going to switch gears and throw it right back at you and ask you, what are you doing that you're most excited about?
We're doing a lot of technical work. We're doing a lot of technical work in cycles. We're seeing a lot of some divergences right now. We're seeing kind of what you're seeing. Next year could be rough. But then part of me is like, I also think we could have this sort of epic blow-off top like the late 90s. I think where we are today is very much like where we were in the late 90s. Could we go another year? Could we go another 18 months? I kind of focus on what you can control, which taxes, looking for ways to get greater yield, how you can structure things with Roth 401ks, solo 401ks. I like tax management, macro diversification. We're doing cycles work. We're doing good fundamental work. I think there are values in sort of the anti-passive trade. I think there is such a bubble in index funds that what if you get a stock like case in point, and we own this, and I don't recommend you buy or sell this but like we saw a flood of money went into, let's say, Lucid due to the SPAC craze. Then everybody lost money. A flood of money went out. Then a flood of money went back in, and then they were included in the NASDAQ 100. That's going to be game changing for them. So we're looking at hidden value by people being included or then reverse excluded in the indexes. So it's something that I think deep fundamental work coupled with technical analysis is kind of a cool thing. I mean, who would have thought Ford, and I kicked myself for not investing in Ford. I saw that coming, but I was like, no, Ford, give me a break. But Ford's been a great buy. We didn't, where Lucid was a good example of us getting in. Ford was a bad example. I didn't get in. But it's very interesting. You get these fund managers. Now, so much is being driven by indexing that people aren't using their brain. They're just buying everything. And so if it's included in the index, it goes up. If it's excluded, it gets kind of withered. So I'm looking at value. We're looking at technicals. We have a great technical analyst. He's in with a lot of your type of stuff. It sounds like you guys are very simpatico. So, we're doing well. And but I always think.
So I have an idea as you're going through that, because you touched on a couple of things. With index funds, the hidden, what's going on beneath the surface is that most index funds, index mutual funds, index managed accounts are tied to, let's say it's the S&P 500, for example, but it happens with the NASDAQ and the Russell. The weighting methodology is based on a rules process that says that the bigger a company gets, the more of it you own in your index. That's why in the S&P 500 index, 5 stocks make up over 25% of the index. Just 5 out of 500 make up most of, that massive majority. So it's because by rule that as the stock price goes up, the capitalization of the company goes up. They have so many shares outstanding, higher stock price, it's worth more. So by rule, the index every quarter adjusts and buys more of it. Well, think about that. And then think about ESG and the craze with ESG. The same thing happens, except more of the ESG stocks tend to be those same 5 stocks, more technology oriented. And so we've gotten ourselves into a position where most of the money is invested in index funds into the very few names that are in that. And if they start running into trouble, then the big unwinds happen. So we have I'll disclose that he's a minority investor in our company. He's a brilliant thinker who started, his name is Rory Riggs, and he's a biotech brilliant investor, and started looking at medicine and looking at the cap-weighted structure in general of the way we invest here in our markets with index funds. And so he started coding. He said, there's got to be a better way to do this than get so heavily weighted. And so he started coding years ago individual companies by their attributes, by their risk attributes. Who do they sell to? Where do they procure what type of product do they have? Where do they procure the products that they have? What geographies? What line of business they in? So think of it like a blueprint, a fingerprint on a company, a deep dive with information, kind of like a global Google Maps of businesses where each business, what makes them up. And his thinking was, what's the healthiest way to own the U.S. market? So we could pick stocks and individual things, and there an active manager can really separate themselves if they're very, very good. Well, a lot of us in the popularity of index funds, ETFs and mutual funds, that's where the money's going. Well, he now has a methodology. It's a weighting methodology. Instead of owning the market by the largest companies get the biggest weighting in the S&P 500 index funds, or somebody could invest in an equal weight of the same 500 stocks owned in an equal weighting to each stock, or somebody could do it like Rob Arnott came out with something called fundamental weight, different weightings. So he has something that he calls stratified weight, which I think is the healthiest way to own the market in aggregate what we in the business call beta, which is what the market should give you. I think it's the healthiest, the truest beta, real beta that exists. So he's got ETFs that he had launched out. We invest in them, so just know that conflict of interest exists. And then also has an ETF where they hedge some of that exposure. So if it's not that ETF won't underperform or won't go down if the market goes down, it's just that the few stocks like in the tech bubble that really fell apart, they didn't come back. And so it's a healthier approach to the market. I think that it's really brilliant with how they're thinking about doing this. So there's a lot of innovation, and we are doing looking at those kinds of things.
Fantastic. And that's a great way to end. 30-second parting thoughts for our listeners. Steve Blumenthal of On My Radar. What do you have? 30 seconds of wisdom. Go ahead.
Well, nothing can be more important than the love you have at home and your family. So going into the holiday here, Merry Christmas. Enjoy your family. I know you've got many. We've got a big family. Everybody's home. It's a great time of year, and what could be better than being with the people you love the most?
Faith, family, friends. Merry Christmas, Happy New Year, Happy belated Hanukkah to all of our listeners and viewers on YouTube. And folks, go to cmgwealth.com, get the On My Radar newsletter free, and you get the free book On My Radar by Stephen Blumenthal, Amazon bestseller, when you call me right now at 888-988-JOSH. That'll be my Christmas and New Year's present to you. Give us a call, 888-988-JOSH, or your Hanukkah gift, late Hanukkah gift. Also, call us 888-988-JOSH, or if you just want to buy the book, go to Amazon. It's up for sale. Thank you so much, Steve. It was a lot of fun. And folks.
Yeah, great catching up. Merry Christmas to you and your family.
You too.